everyone, and welcome back to Multifamily Report. I'm your host, Travis Watts. In today's episode, we are talking about lending. We're talking about commercial and multifamily loans and the decrease that we've seen here in Q3 of 2022. Now, this stems from an article published by Multifamily Executive here in November 2022. And the first thing I want to say to kick this episode off is it's not uncommon that you're going to have less people borrowing at higher interest rates like what we're seeing this year compared to 2021. The goal of the Federal Reserve this year is to slow down inflation, and that also means slowing down the prices of goods and services. This is one way the economy is being affected. In fact, this article goes on to say, quarter over quarter, originations for commercial and multifamily have decreased 13% in the third quarter, with multifamily experiencing a 12% drop. In addition, originations for office properties have decreased 31% quarter over quarter. Retail saw a 27% drop, healthcare properties 21% decline, and industrial a 6% decrease. So it is not just single family homes. It is not just multifamily real estate. This is all types of real estate. And to that point, I guess one takeaway, one thought is sellers in real estate are often hesitant in the short term to have large, drastic discounts on properties. It takes a while to kind of sink in. The Fed has been so aggressive, nearly doubling rates over the last year. And so sellers aren't wanting to decrease prices accordingly. And so we're seeing less transaction volume happen as a result. A parallel you could think about is, have you ever noticed at the gas pump, for example, if oil prices shoot up, let's say very rapidly, well, gas stations are usually very on the ball, right? They're hiking their prices immediately, same day, next day. It's very, very immediate. Now, when oil falls in price, again, they're very hesitant and reluctant to start lowering their prices. Sometimes that can take a week or longer to start reflecting. So a few takeaways and considerations when you find yourself in an environment like this with rising rates and high inflation is, number one, it's a good time to be a holder of real estate. If you were able to lock in a low interest rate, let's say even 1 year ago, and a lot of people are holding properties they bought 4 years ago, 3 years ago, 2 years ago at 3 or 4% annualized interest, then you may just want to weather the storm and not list your property for sale unless you have to. We've seen a very rapid rise in rent growth over the last 2 years. So you should be sitting in a good position as long as you have enough debt term left. And the second takeaway is this is actually a good market condition for buying real estate. As interest rates increase, it does negatively impact the selling price. And you have to remember that some holders of multifamily real estate, to use that as an example, have to sell either because their debt term is up and they don't want to renew at a rate that's double what they had before, or they've already executed their complete business plan. They've remodeled all the units and now they're looking to sell, or contractually they're obligated to sell, which happens a lot in the institutional space. So as we start seeing the price dips happen, that is an opportunity to get in and buy the dip. And the third takeaway is if you are going to be a buyer of real estate or multifamily this year or moving into 2023, remember there's a few ways to protect yourself and protect your investors' capital. Number one, you can buy what's called an interest rate cap, which is a lot like an insurance policy. Say you're getting a 5% mortgage today, you might buy an interest rate cap at 6%, which means if the Fed keeps hiking rates further and further, you would essentially be capped out at 6% and not having to pay 7, 8, or 9% if they go that high. The second thing you can do is you can lock in fixed rate debt at today's rates if you're of the belief that the Fed is going to continue raising rates, and that way you can have a long debt term that's not going to fluctuate or change. And the third thing you can do is find an assumable loan, which means that a future buyer can take over the pre-existing loan, ideally at a lower interest rate than what's being offered at that time in the future. And the last consideration in an environment with rising interest rates is to remember that real estate has a lot to do with supply and demand. So again, all of the purchasers of the last few years that were able to get low interest rate debt are often going to hold on to their properties in an environment like this. They're going to reap the rewards of rising rents and reap the rewards of having a low interest rate, and they're going to be reluctant to market and sell their deals in an environment like this, which results in less inventory for people who do want to purchase. And so with less inventory, that correlates to more competition. And with more competition comes better price stability for those who are already in the game. So with that, happy investing, everyone. Thank you so much for tuning into Multifamily Report. I'm Travis Watts, your host. If you ever have questions, want to take a deeper dive or learn more about multifamily investing in 2022 or 2023, you can reach me at travis@ashcroftcapital.com. Have a great week. We'll see you in the next episode.